And so I was like, tell your boss that you met Sharon's boss today and that you're going to have your 401 set up the right way. And we talked through the differences in Roth and traditional. And so you saw some kids taking notes, which is exciting. And then you've had other kids where you're like, I am literally forfeiting time and money to sit here and talk to y'all, and you're not listening to me, and you're playing drug deals in the back of the class. It's cool, whatever.
Yeah, it's kind of disappointing. What I did is I started out by this. There's 30 of you in here, right? I said 6 of you are going to be multi-millionaires. I said 6 of you are going to be bankrupt, and the rest of you are going to be average. I said, let me tell you who the 6 that are going to be multi-millionaires are. The 6 of you who are going to be multi-millionaires are the ones with paper and pen and are attentive and writing. I said, the rest of you, we don't care about you anyway, because you're just average and failures. I said, but for you 6, I am here for you, baby. And you should have seen this one little guy. He wanted to be a real estate agent. And man, he was writing. He was hungry. You ever seen a student that's just hungry? And he was writing and taking notes and all this. And I passed out my business card to all of them. And I said, y'all probably don't even know what this is. It's a piece of paper. It come from a dead tree. And I said, it's my business card. I said, call me. I'll help you. I'll help you. We'll set up your Roth. We'll set up everything. And so, some of them were genuinely interested. Now, when they really got interested is when I showed them Portfolio Visualizer and showed them how much, if they had invested in the SP 500, 13 years ago, what it'd be worth today. And all of that, they got their tongue wagging. And then it got their tongue wagging when I showed them something else that I'll show you at some point, where they could have become a millionaire in 13 years with just starting with $10,000. And that got them all, excited. But yeah, I agree. You can't, like I say, you can lead a horse to water, but you can't make them drink. And isn't it amazing how often the bell curve comes into effect? Even in a class like this, there are people who have not done the first assignment yet, and that's fine. And they'll wait to that very last minute, but invariably I'll have 2 students in this class that will fail. How you fail this class is beyond me. It's just by not participating, just by not doing the stuff. So I appreciate that you guys every day come in here and are part of the class. So it really makes, really makes a difference. But it was a good experience. And what was it that Sharon told us, Katie, about I used the line about, hey, you're going to be where your parents are. I kind of did that, right?
Yeah. So she said, look at what your parents are doing. And I asked the class today, I said, your parents don't owe you much in life. They need to make sure that you're safe, you're fed, whatever. But if you go home tonight and you ask them what was their biggest financial mistake, they owe you that answer. And I said, and if they're not going to answer, you just say, okay, then all of them must have been. And one girl, and it hurt so bad. She's like, I was my dad's biggest financial mistake.
Oh,
like, why do you say that? And she's like, well, he was 16. And I was like, so how old is he now? And she's like, he's like 35. And I was like, oh God, that's how old I am. I was like, oh, that hurt. But I told her, I was like, you are not his biggest financial mistake. What he did is the financial mistake. And she's like, oh, but I learned from it. So don't discredit that, Miss Katie. And I was like, oh, okay. But it was, it was good. And just, yeah, I think if anything, the best result for me in my business was that the teacher wants to have me back. And she's like, do I need to talk with you first or my attorney first about my estate planning? I was like, we can start.
Oh, that's great.
So,
yeah, I don't think I'll get invited back because I basically said, look, how many of y'all are going to college? And most of them raised their hands in 30 minutes. I said, that's way too many of
y'all. Right.
Did y'all know this? You may not know this. I think the number is this, like 50%, and don't quote me on this, okay? Or I'll probably get fired because of this. I think 50% of the students that start at the University of Alabama never finish their degree.
It's higher than Auburn.
Yeah. And everybody wants to come to Alabama because, hey, we got a good football team. And so we come to Alabama, and next thing you know, they're not finishing. And what are they saddled with? They're saddled with the debt of the student loans. And I told these kids, hey, it's okay to take 8 years to finish school if you're having to work while you're doing it. So a little girl comes up to me. She says, hey, Bobby, she said, I'm going to be a teacher. What should I do? How am I going to pay for school? I said, girl, you're going to substitute. I said, they're begging for substitutes. I said, hey, get your bus license, drive a school bus. You'll have benefits and everything. I mean, if you drive a school bus twice a day, you'll be fine. Go to school during the day, drive the bus in the morning, drive the bus in the evening, get insurance and benefits. I said, that's what you do. You want to go into education, drive a bus and be a substitute teacher. There's all kind of ways these kids can do that without having to get because here's what I told them. I know what you're thinking. You're going to get the loan and you're just going to spend it on tuition. No, you're not. You're going to buy a pizza and you're going to party on Thursday night. That's exactly what you're going to do with all that money. So it's really sad that it's so easy to get the student loan money that people just spend it on anything. And y'all know it. Some of y'all got the student loans, right? And you're like, oh man, I'm going to, and then you go, instead of just getting the amount of tuition, I'm going to max that puppy out. I'm going to put it in the stock market. Right. Yeah. Some people day trade with their student loan money. So, you know, whatever. But anything else that was a takeaway from you, from that at all?
A little different. I'll tell you that I ran across a really neat podcast.
Yeah.
That had me going this morning. Molly Fletcher. I don't know if you've heard of her. Anyway, Molly Fletcher is the female Jerry Maguire.
Mm-hmm.
And so what she does is she interviews like top peak performers, is what she calls them. She interviews peak performers. And there is a girl named Tori Dunlap. Have you heard of her? Has anybody heard of her? So she's like maybe not even 30, but she's a financial coach. And so some people will love her. She's on the liberal side. Some people, it'll take a while to get through to what she's having to say. But the podcast that Molly released on the 19th of December last year was phenomenal. And I think that there's a lot, especially more for the females in finance and like women and the way that they're saddled. It was, I don't know, different takeaway, but a lot of the things that women are required to do in order to be successful, it's you need to look nice, you need to spend money on makeup, you need to have your nails done. And it's a lot of the things that we get shamed for, like spending our money on. Like you don't need to be going and getting a manicure, you don't need to get your hair done. But yet if we don't do that professionally, we're kind of like, you look tired, you look like you're not professional. And
you look like you just woke up, Nick.
Yes. So it was like, shut up, I got a kid. You know, oh, now you're using that against me. But that was a neat tool. And so Tori Dunlap, I don't know how on board I'm going to be with her, but she released a book last month or the month before, which might be interesting to check out.
Well, send us all a link to it or something so we can, check it out to the podcast if you can find it or something.
Yeah.
Good. That's very good. Let's talk about Colin's book. Are y'all all reading it, or is anyone that would admit, look, Bobby, I hadn't got into the book yet? I mean, that's fine too. Hey, Isabel. Hit your space bar. I can't hear you.
Sometimes my space bar works, sometimes it don't.
Okay.
I have questions about part of that book. So
Okay.
whenever we get to that section, I have questions.
Oh my goodness. Well, I hope I can remember it because I'm trying to read it again with y'all. I try not to make y'all do readings that I don't do. So I try to read it every semester. Things change up what we do from semester to semester. But let's talk about this. We were on part 2 here. How to harness the world's most powerful wealth building tool. Index funds are really just for lazy people, right? Let's discuss that. Anyone agree with that index funds are just for lazy people? Tell me why it's not just for lazy people. Shannon's been quiet. Let's call on Shannon.
I knew you were going to say that. Because you have to adjust it. So yeah, you can be lazy and allocate how you want and just leave it alone, but you do have to go in and readjust it to be sure that you're still meeting your 75-25 or 80-20 or whatever it is. But it's kind of lazy because you don't have to worry about it. You don't have to change your stocks up. You don't have to do whatever, as long as you have like your S&P 500 or whatever. As long as you have your foundation, you don't have to mess with that. You just have to basically be sure that your percentages are where they're supposed to be.
What I did the entire time I worked for the federal government is I put 100% of my money into the C fund. For those of you that may be familiar with the C fund, it's the S&P 500. And I did that year in, year out. And every time I got a raise, of course, it automatically put more money into it. And I just did that the whole time. That's all I did. Now, was I lazy? No, I was prudent. While everybody else was bringing money in, bringing money out, and coming in and out, and doing the F fund and the G fund and all this fund, I just put it in the S&P 500. It's so simple, but it takes discipline to do it. So yeah, index funds are not really just for lazy people, but we've got to understand that your clients have lives. They don't want to sit behind a computer and do like I do and trade every day and do options and futures and all that kind of stuff. There's other things they want to do. And so they're calling on you to kind of help alleviate that. And the problem is what we've shown is it's so simple that they can do it themselves. Again, what did we say with my personal trainer? Yeah, if I take in less calories than I burn, I'm going to lose weight. Well, that's easy. Then why have I been obese for a majority of my life? Well, just because I can't do that on my own. So you're not putting yourself out of a job. What you're doing is holding your client, your family, whoever you're working with, the students at the school, you're holding them responsible and giving them a level of accountability. So it's not just for lazy people. People just lack the discipline. And the discipline is putting the money in, day out. If you have to write the check, you're not going to write the check. If it's an automatic draft coming from your paycheck or from your bank every week or every other week, that's the discipline that people need. That's the discipline that people need. Okay. Now, I told the high school student, hey, yeah, Juwan.
I have a quick question, and this might be a little bit too whatever. So we can discuss it now or discuss it at a later point in time.
I wear boxers. Was that the question?
Oh my gosh.
Oh, that was not the question. Oh, sorry.
No. But it's specifically looking at inverse index funds and how they are utilized within your portfolio. So we've talked a lot about, seeking out index funds and investing in the S&P 500. So that way, we can build our wealth alongside the S&P 500. But in periods of volatility, kind of like we've been experiencing over the past 2 years, have you used index or inverse ETFs to kind of benefit from that, and or how does that play into the way that you structure your portfolio?
Yeah, I've not messed with inverse at all. Not done that at all. It's really kind of hard for me to even fathom how I would use them, but not saying that they're not good. For example, one of the things that I was doing, and Katie, thanks for sharing that, is I was using leveraged funds, leveraged ETFs. Has anyone ever heard of TQQQ? Okay, you know what the NASDAQ is, right? There's 100 stocks in the NASDAQ. If you're going to buy the ETF that represents NASDAQ, it's QQQ. So there is a leveraged QQQ fund called TQQQ put out by ProShares that says if QQQ goes up $1, TQQ goes up $3. But at the same time, if QQQ goes down $1, TQQQ, which is triple leverage, goes down $3. So I've used triple leverage, but not inverse leverage. Has anyone else here have an experience with something that's an inverse fund at all? Would you like to share? Katie, I can't imagine you using it with any client at all.
Can you explain what an inverse ETF is?
Yeah, so it's like SQQQ, I think is the thing. SQQQ is it goes up if the NASDAQ goes down. So they've got an inverse relationship. So it may have an inverse relationship to whatever the underlying is. So SQQQ, if NASDAQ goes up, this fund goes down. And if NASDAQ goes down, this fund goes up. So it's just basically just flipping it around. So you go, oh, wow, like you could get an inverse fund for the Dow. and the Dow's down 100 points. Well, if you had the inverse Dow ETF, you'd be like, yay, you know, because it was up on the day. So that's the thing. Juwan, I'm just curious, you bringing it up, do you have experience with it, or have you used it in your portfolio?
I personally have not. It was just a thought from the conversation that we were having.
Yeah, great. And I appreciate you bringing that up. It's just
It
not
seems
something,
very
yeah.
more short term. So that, like, everything I do is long term planning.
Gotcha.
So that's where I wouldn't, I mean, am I wrong, Bobby? But it's more of the short term, lots
Well,
of trading versus.
Yeah, that's what people say with the leverage things too. I tried to hold it long term, but couldn't. If I had held my TQQQ and my bonds last year, I would have been down 76% in 1 year. Fortunately, I bailed on it before that. But yeah, I think that's kind of the thing that these are used for, shorter terms. If you have some opinion on market direction and you want to take advantage of that, these are things that you can use. Now, that's what we're trying to tell everybody is your opinion really doesn't matter. Having a market opinion is one thing. So you may ask yourselves, why do I even introduce options and things like that to you, when really the best way is just to put money in SP 500 or the total stock market and just let it fly. Some of you may want to be active traders. I love it. Oh, y'all, it's my passion. I trade every day, and I can do it in about 15 minutes, but it takes me an hour to explain what I'm doing. And I just love it. I just love being engaged in the market. But after my hour's over, or my 15 minutes to an hour's over, I'm done. I don't care about it at all. Ed, what are you clapping about? Ed did his little clap on something. Not sure what Ed's clapping about.
Hey, good afternoon, everyone.
Hey, Ed.
I wanted to comment on a couple of things.
Mhm.
You're teaching to potentially enter stocks or equity positions by selling a put, as you introduced early on.
Yeah.
You can do that on these ETFs as well. So there is an advantage, a situation where you can merge the two. If someone wants to go into SPY as a longer term investment, they could just sell puts on it to take in premium while they wait for the price to pull back and execute. So there's that. And then, a lot of the ETFs are quality, like SPY, and then the sector funds like EEM, which is the Emerging Markets Fund, which allows you to spread your money all around the world in a very low cost index style investment. I'm not recommending any of these, but I would recommend SPY. But they're very low cost and give kind of niche exposure. And then regarding these 2 and 3 time lever funds and inverse funds, most of those are loaded with futures contracts and or options. And when they roll, if you really look at one of these things over the long run, oftentimes you see a consistently declining chart. And like USO is one of them. Excuse me. USO is an oil ETF. And it's funded with futures contracts. So whenever they roll a futures contract, there's a loss of principal that occurs. So it's almost a systematic destruction of value if held for the long run. So the young lady, I'm sorry, I missed her name. She was saying, aren't these short term? They are short term, like intraday or very short swing trades. Because of the structure of a lot of these things, they literally are designed to go down in value. And if you do pull up one of these and you see that long-term declining stock price, actually do some research and see how many reverse stock splits some of these ETFs have had. And it's amazing. They'll like go from 50 down to $2 and they'll do a 30-for-1 reverse split and it goes back to 60. And a lot of this jargon may not be familiar to you guys, but a big red flag of caution when it comes to the levered funds that are the multiples either in the same direction, like it's long the S&P by 2 or 3 times, or it goes opposite. Usually those things are not great. So I just want to chime in on those little things.
Good, Ed. Thank you. Now, when I talked to the kids yesterday at the high school, I told them they don't need bonds in their portfolio at 18 years old. If you're getting a job and you're starting with your Roth IRA or you're doing 401k, you don't need bonds. I don't think you need bonds for a long, long, long time as far as part of your 401k or your Roth IRA. Now, we're going to speak some about I bonds and we're going to talk about treasury bills, things of that nature, but I'm talking about just for the growth portion of what you're doing. And I will disown any of you in here. Listen to me. I will say I never knew you, depart from me. Okay. If I ever hear any of you recommending a 60-40 stock bond portfolio, any idiot can do that. That should never be your recommendation. Even if you go 59-41 or whatever the numbers are, I don't ever hear you be 60-40 because anybody with a pulse can recommend that. And I'm tired of that 60-40 bond portfolio. What would have happened to your portfolio if you were 60-40 stocks and bonds last year? Down on both of them.
Nowhere to hide.
Yeah, there was nowhere to hide. 2022 was the year where bonds and stocks were both headed down. And people say, well, you've got to have bonds for diversification because when stocks go up, bonds go down, and bonds go up, bonds down. That's a bunch of crap. That didn't happen last year. It didn't happen at all. They were both down. So never just throw in bonds for the sake of throwing bonds in. If you're putting bonds in there, make sure you have a reason for adding bonds. So if you're 18 years old, you need to be in stocks. You need to be in the S&P 500, or as J.L. Collins says, he prefers the VTSAX over VOO, which is the Vanguard S&P 500 fund. But I personally prefer the S&P 500. So either way. But for an 18-year-old, you don't need bonds. Does a 20-year-old need bonds? No. Does a 30-year-old need bonds? No. Does a 40-year-old need bonds? I don't think so. Does a 50-year-old need bonds? Maybe a little bit. Does a 60-year-old person need bonds? Okay, I could go with that. Does a 70-year-old person need bonds? We got to figure out everything that's going on with them. But yeah, I can buy that. So, at some point, yes, some, but you can't just totally give up growth, can you? So what is your opinion on chapter 12 where J.L. Collins is talking about bonds? Oh, there's Isabella back. How you doing, girl?
I'm good. How are you doing?
Fat and sassy. Thanks for asking. So Isabella, what do you think about bonds?
I think you definitely from the book we were reading,
Yep.
I think even now, like I'm 22, so I feel like I'd probably have a small amount of bonds. Like he said, there's scenarios where you should never have less than 80% stock, but like you can add about 20% bonds in. Like I don't think I'd do 20% bonds at all at my age, but
Please don't.
no, I won't. But he said there's like some scenarios where you can like maybe add them in here or there. I don't know, just to see what's going on. Kind of like experience it. I don't know. I know you're probably going to recommend all stocks for me.
Yeah, for you, I would. At 22, I would recommend all stocks for you. But if you want to use it, kind of like, I love a white cupcake with vanilla icing on it. Oh my gosh, ain't nothing better. But, do I really need sprinkles on my cupcake? A little texture is okay, a little sprinkle here and there, but I'm just as fine having it without the sprinkles. So if you want to sprinkle a bun in here or there, that's fine. But for your age at 22, I would let it run with the stocks. Let it run. Take some risk. Anyone else got an opinion on bonds? I always like Katie's opinions because she's in the industry now. And she probably has to go along with like what her company kind of pushes and things of that nature. So,
Yeah.
you've got constraints, but I hope that they're not a 60-40 all the time. Come hell or high water.
No. And last year I had a few clients that were like, get me out. And I was like, no. If I have to, I will take your portfolio objective down a notch, but I'm not getting you out. And I hated doing that too, because I was like, this is what we're doing. So you're essentially capturing your losses. I have some clients now that are muni bonds are exciting for a lot of my older clients. They like that. Tax wise, I guess I would like to go through a tax class again. Like, okay, let me rephrase this. I'm looking forward to the tax portion when I study like with Danko or Dalton for CFP. I'm looking forward to that so that I can grasp a little bit more knowledge on tax. But I see the point of munis there. And that's why I have some of my clients that are like, hey, get me munis. And if I was to inherit, a good municipal from my parents, I'd probably let that thing just continue on unless I can sell it for premium. But am I excited because our portfolios are all equities and I've got about 5 guys that are in all equities.
Wait a minute,
but-
when you say all of our portfolios are all equities.
No, not all of them. Ours start with all equities and then you back down to an 80-20. And that's
Okay.
where the majority of my clients is in an 80-20. And depending on the account that they choose determines, do we hold to those guidelines or not? And the client gets that choice. And so it's nice when they're adding a little bit of money at a time. And I'm like, let's just build this one up before we even worry with the next one. So I appreciate that. But then we go to like a 65-35 and that's where I'm like, oh, here we go.
Here we go to the 60-40, right? I mean, you're
Mhm.
close.
Yeah, but then at the same time, here's the trade-off. If I have people that are extremely low risk and they would not be in the market at all, and that's going to give them some kind of intro, 2020 to 2022 aside, I at least look at that and say, they're 65% in stock. They're doing better than they would be in a CD because CD rates started to go up last year. And a lot of people were like, oh, I can put money in CDs. And they were wanting to bail on the market and capture their losses and put that into a 4.5% CD. So I have to look at would you rather losing game?
Okay, great. Isabel. We got Isabel and Isabella with her. Hey, y'all fight it out. Who goes first? Hey, let's
Isabel
do,
can go first.
what is it?
No.
Rock, paper, scissors, shoot.
I'll go first.
By the way, I play rock, paper, scissors, shoot with my 6-year-old, and she's so funny. So I wait until she shows what she's doing before I'll do mine, and I beat her every time, and she gets so frustrated. She didn't even know that I'm doing it. Anyway, I shouldn't do that. But go ahead.
When y'all talk about bonds, are we talking about bonds that are like the EE and I bonds, or are these different bonds?
I think what we're talking about now, what J.L. Collins was talking about was like bond funds, right? He's talking about different bond funds that are in there. And I can't even remember the Vanguard symbol for bonds, but there is a total bond fund, kind of like his VTSAX is a total stock fund. There's a total bond fund. There's all kind of bond funds. Yeah, Katie says corporates, munis, all of it. I mean, there's all kind of different funds that are there, but most of you guys will not be putting them in the individual, Coca-Cola, a bond, issued by Coca-Cola. You're not going to be doing stuff like that, but it'll be more of a bond type fund that has a group of similar bonds packaged up in it. Does that kind of make sense? So what he's talking about, if you got to have bonds, look at a Vanguard all bond fund, if that's available to you, or something that's similar. Okay, Isabella, yes.
I was actually going to ask Katie, what would she recommend for somebody my age? Like what percentages?
Oh, I love it. Yeah, Katie, what
I
would
can
you
get away
do?
with what Bobby's telling you to do?
All stocks?
So for us, my husband will be 38 this year. He has a part of his money is still all equities, and I love that he does it. Sometimes I'm like, oh, I can't believe you're doing this, but we can do it. We have time to recover, and you have more time than we do. So why wouldn't you? Like, I wish I'd taken this class 15 years ago.
The other thing I'm wondering is, like, when I get to the point where I start having kids, for example, or just something like that, would you recommend getting more conservative, even just a little bit, or no, still just keep going? No.
Your kids don't dictate your finances.
And Isabella, you may not have been here at our last class, but we made sure of this. Or who was it? I said, yeah. We were like, look, you have got to take care of yourself before you take care of your kids financially. Now, that doesn't mean you let them go without food and clothing. Nobody misconstrue what I'm saying. What it does mean is that you don't start saving for their college until your retirement is fully funded. Okay. Because, everybody's like, oh, let's set up a college fund. And you don't even have your retirement, because here's what's going to happen. You're going to be moving in with your kids, and you're going to be, bedridden, and they're going to be having to wipe your butt 18 times a day and give you sponge bath. They don't want to do that. So trust me, let them pay for their own college, and you worry about your retirement first. And if somebody disagrees with me, fine. That's totally fine. But Isabella, listen to me. At your age, oh my gosh, this is the class I wish I had at your age. So just like Katie said, please put it in the S&P 500 or put it in VTSAX, the whole stock, whatever, and just let it run. Don't look at it. Just go.
Sounds good. Thank you guys. I mean,
Yeah.
I'm very grateful I'm taking this class. So
We're glad you're here. We're glad you're here. Yeah, Katie.
Evan can go ahead of me if he wants.
Evan. Oh, Evan. I didn't see Evan saying. Go ahead, Evan.
Oh, you go for it, Katie. I'll jump in after you.
Okay, I was just going to say another part of that podcast I listened to, and I thought this was really interesting. She said that kids typically will have their perspective or perception of money ground in and cemented in by the age of 7, which I thought, surely not. And then I started realizing my mom, even though we had money we never wanted, we never had a need for anything, but she did allow us to want. And she did, they pushed in savings, and I've shared that, my great grandfather was save 10% and do all this. So I knew that before I even started kindergarten, because it was talked about. But then other children who, we don't have money. So they grow up, realize we don't have money. And they either think that's okay, and they go along their lives with no money, or they end up hoarding all of their money and not do anything with it because it's all ground into them. So the only thing I would say about with kids is get them involved in their finances at some point. So we take care of ourselves, but then we do that small little account for each of our sons and put a small amount in there, so that way we can use that as a tool to train them. But that's because we're able to. And so my son, who's 6, he comes to me every birthday. Here's my money for my account, Mom. Here's my money for my account. And then he did. And I had to realize he decided he was going to buy a Hot Wheels car. It's $50 stupid plastic truck. But he had the money, and he had more, and he doesn't spend it frivolously. And so I had to also realize that I didn't spend money growing up, and it's very hard. I finally bought my first designer bag on a 75% off sale at the age of 35. And I felt guilty as hell for doing it. So I had to also, tell him, I'm very proud that you saved your money. I'm very happy that you enjoy what you bought. I think it was good. It's something you're going to be able to hold on to and play with for a lot of time. And so we utilize that. So it's just teaching, let your actions teach your children about money versus putting money aside for them completely.
Great. Yeah, good comments. Yeah, Evan.
I was just going to say, it kind of goes back to the conversation we had, was it last week or Tuesday, about living on 70%. If you're living on 70%, you're investing 10, saving 10, donating 10, I think was the guidelines you had kind of thrown out there. Having kids, having a family should be coming out of that 70%, and then that 10% that you're investing, more often than not, is going to go into a retirement account that you can't touch until you're 59 and a half anyway. And if you do, you're going to get severely penalized for it. So there's absolutely no reason to make those investments, quote unquote, safer or anything because you've had kids, because you aren't going to touch this money until you're 60 anyways. So I would definitely just leave it in an index fund, let it go. And if you hit 50 and you're like, okay, maybe I want to start calming down a little bit, then I think that's one thing. But we're all so young now that I'd say we should be leaving it there for a while.
Yeah, exactly. And here's the thing, y'all. I retired at 51. I'm 52. So, or retired, other than, I teach this class. But other than that, I'm retired at 51. A lot of people says, Bobby, oh my God, your life is over. Let me tell you something. Y'all may not believe this. I'm older than y'all, most of you in here, but life is still fun at 51. It's kind of cool, right? I'm having a lot of fun. So, people think, oh my God, I'm that old. Oh, who cares? No, it's still like you still have fun. Life is fun. So enjoy it. Oh, I like what Juan said. Let it go, let it go. Put your money in the SMPO. That's what you do, the SMPO. I love that. Okay. Oh, if I had to watch that movie one more time. Katie, you know what it's like, probably. I know you got a son, but he probably likes it. Yeah, he doesn't like Frozen? Really?
We do a lot of travel and Bear Grylls.
Hmm.
I'm so
Okay.
glad I have boys.
Yeah. Well, I got 2 of them, but we still like Frozen. All right. So in
Really
chapter
quick,
13, what was that?
sorry, Katie, that does not mean anything. I tortured my family with the Hannah Montana soundtrack for about
you're-
2 to 3 years straight. Road trips, all of it. They were so happy when I moved past that place.
Party in the USA played every time my roommate took a shower. And she would shower like 3 times a day. And it was stupid. Party in the USA. Like, stop. You don't even
That was
party.
happy time, her scrubbing.
Hey, that was her theme song. That's kind of cool. All right. I like that. Okay, in chapter 13, J.L. Collins talks about portfolio ideas to build and keep your wealth. Of course, if you are 80, right, you may have another 20 years or more to live. I don't think at that point, though, don't you still think that you need growth? I'm not 80. I'm a few years from it, but I would think at 80, I still want growth. What if I do have another 20 years to go? Now, if you've got ample funds at that time to finance the next 20 years, maybe not so much. But what are your ideas on that? Portfolio ideas to build and keep your wealth. You certainly would not want to be 100% in the S&P 500 if you're 80 or 90 years old. I think we all realize that, because a 20 or 30% down year could be catastrophic if you don't have enough money to carry you out for the remaining years. Anyone with a comment or question on how you would handle something of that nature?
Yeah, I would say that I think it kind of goes into your retirement plan from the very beginning. If you go into it and you say, I have X number of dollars, I want to withdraw 2% a year, 3% a year. That number is adjusted for inflation. So at 80 years old, that plan should be no different than when you were 65, unless you kind of change your allocations to different funds or whatnot. But personally, I would say even if the market's down 20%, you withdraw your 2 or 3% because that's built into the model, and you follow that plan. I think that's probably a pretty reasonable approach. I don't feel like that's going to take things too crazy off the rails.
Yeah, good. So how do you select your asset allocation? How do you select, I want to be this much bonds or this much stock? I know that there are equations out there that are tossed around, the 60-40, or doing something based on, number of years and doing a number like that. Yeah, Juwan, go ahead.
I would add is that I kind of think that, actually, no, I don't kind of think. I think that it really depends on how you, like, the purpose of those funds. So, like, for me, all of my accounts have a specific purpose. And for example, if you are at the point in retirement where you're like, all right, we're living, we're 80, we're good financially, and we just got extra money that's just, growing and sitting on, then that could be something that those funds in that investment account, that's something that's for your grandkids, or that's something that you want to leave for inheritance. So to maximize growth opportunity from that inheritance standpoint, then that might be an opportunity to keep that aggressively invested in mostly stocks, or 90% equities, 10% bonds, or 100% equities, etc. So I would say that it really depends on kind of your needs in retirement and how you go about, structuring the income that you have.
Oh, I think that's a great point, because that is true. A lot of people who have the wealth, they really don't even need that money. I mean, they've done so well in every other areas of their life. If it's in retirement accounts, they're like, yeah, the chances of me ever needing that are, slim none. So they may want to donate it to charity or to some charitable organization. I mean, look at Warren Buffett. he's giving away most of his money when he passes, right? Not to his children, but he's passing along charitable organizations, and his children, he let them know from an early age, hey, you're kind of doing your own thing. Now, not that they won't get something or he hasn't helped them along the way, but he has a purpose for that wealth that he has acquired, right? And you'll notice that most people are not the flamboyant, driving the Ferraris and all of that. If you read Thomas Stanley's book, The Millionaire Next Door, it's the real estate appraiser driving the 79 Ford pickup truck, shopping in the Piggly Wiggly. That's your millionaire. They're just not very flashy. You never really know it. So yeah, what is the purpose for that money? Good. International funds. I had this question from the teacher yesterday of the students that I spoke with. She said, what do you think about international funds? Don't they need international? And I said, well, if you get the S&P 500, you've got Apple, you've got Tesla, you've got Microsoft. Do they only do business in America? No. They do it everywhere. I just don't think that we've got to pick up a Nestle to be international, to have international exposure. I think we get plenty of international exposure with either the total stock market fund or with the S&P 500. I'd love to hear your thoughts on that. Let's discuss this.
I think that excuse me. I think that that's very valid when getting exposure to international exposure. But I would then also argue that even though those companies are international, that they're still, for the most part, based out of the US. The currency that they use is the US dollar. The way that they are legally operating, it's based in the US, as opposed to, looking at investments in other countries or, emerging markets or currency, etc. I feel like it has a little bit different potential in the way that it's used specifically. But then that being said, it also opens you up to a significantly more amount of risk from like political instability, currency exchange rates, and the value of the currency in comparison to the US dollar. If there's any kind of geographical whatever, like, what's happening in Russia or in Ukraine, look at what happened to the value of the ruble, for example. With those international investments, because of that instance and the severe decline of that value, that's then going to impact any international investments. But then you look at other countries that, there's a huge influx of investments going into a few other like South Asian countries, as companies are shifting manufacturing out of China into other areas, and or Africa as well. Those are also emerging markets that has opportunity for growth. So that could be a way to invest in that, and that's valid, but you're still subject to those political risks, the currency risks, etc. So I will say I do see your point in the fact that they do operate in international markets, but because they are still based out of the United States for the most part, I don't know that international exposure would still, it has the same thing. Does that make sense?
Oh, absolutely. And Juwan, I certainly wouldn't fault you for adding international to your portfolio or recommending it to your clients. No problem with that at all. As a sprinkle on top of your cupcake, I think it's great. Katie, what do people clamor for? Are they sitting there when they come to you going, "Oh, I got to get international exposure"? What is?
They hate it.
They hate it.
They hate. Okay, so I'm dealing with a lot of for those of you who know Alabama, I'm in Coleman. Okay, so there's that. Most of you don't, but blue collar, church on Sundays. That's my clientele base, and there's nothing wrong with that. American made.
Purple hair.
Not at all.
No purple hair?
No.
No, I mean blue hair.
No.
Your mama never had blue hair? after she did her little dye in it or something? You know what I'm talking about?
No, I know what you're talking about.
Okay.
But Matt says, I know Coleman.
Yeah, Matt knows.
And it's
Coleman.
getting better. Coleman is getting much better. But you have to just realize that traditional Southern mentality is still very prevalent here. And so they don't really like the international. Now I explain, here's where some is good, here's where it's not. I do kind of align more with what you're saying, Bobby, as far as, hey, it is here. But when you know, we've got Taiwan Semiconductor and we're worried about Taiwan getting blown up and people are like, what's going on? They don't know. I think if you're gonna dabble in international, the way that Jawan explains it, you have to be willing to be on your P's and Q's with the news to understand what is in the portfolios for the clients that you're taking care of. But does it have a place? Yeah, it has a small place. Now, if I'm supposed to have so much in a portfolio, I'm going to get on the shallower side of that. That's the strategy I like.
What's kind of the most exposure anyone that you would recommend in your practice having as far as international exposure, as far as a percentage?
I mean, you asked me that and it's like, what would I recommend versus like what I'm tied to because of the firm. So that might be two different answers and I'm going to defer.
I got you. Okay, good. Yeah. So what I like about the S&P 500 is I know that it is a self-cleansing item. So if Tesla goes bankrupt and drops out, someone else is going to replace it. You know, so it's always replenished with the new, latest, greatest up and comers that are established, the 500, biggest companies in the United States. So I would say that if you're looking at an international fund, make sure that you understand how a company that goes bankrupt within that international fund, how is it replaced? Is it replaced? And be aware of how it replenishes with new up and comer foreign entities as well. Any other discussion?
And then, well, I mean, when you get into some of these bigger firms, a lot of the places they're still doing because of the traditional views that many of the investor or the advisors have, that I don't want to be an ageist, but as people retire, you start to see, I mean, we saw that. We saw a wave of retiring advisors, and then all of a sudden you saw this wave of ETFs being used with the replacement of those advisors. When that happens inside of the mutual funds, I think you have to be extremely cautious of the capital gains that are happening, especially in so what an IRA, but when you've got these brokerage accounts and you're dealing with money there, that self-cleansing versus, okay, now we're in a mutual fund and it's going to affect the taxes of my clients. I think that's where I go back to, I'm ready for more tax education, but because you have to share that with your clients too.
Yeah, good. So here's what I want you to do for next time, because we're going to take a little bit of a break from Colin's book next time. We're going to do something kind of fun next week. I would love for you to have your Thinkorswim open next week. So what I'm going to do is this. I would like for all of you who are actively here to think of 2 companies that you would like to put a position on. And we're going to do some short-term positions, right? So we're going to do some short-term positions because I want to see you guys manage your option positions. I want to see things happen quickly. So next week, I want each of you to choose 2 companies that you would like to do some options trading in. And I want you to tell me if you're bullish on the company, which means that you think it's going to go up, or if you're bearish on a company, you think it's going to go down, or if you're neutral, you have no opinion as to market direction. So you're bullish, you're bearish, or you're neutral. And then I'm going to show you how to put on some options trades around your companies and your assumptions. Also, we will look at if liquidity is sufficient for you even to make an investment or a trade in those companies. Yes, Katie. Katie, I can't hear you.
Clarification questions.
Yes.
So you want 2 individual company stocks, not ETFs, correct?
Yes, I'd love 2 companies. Yeah, stocks, right? Tesla, Apple, and try to use something. I mean, don't everyone choose
Sure.
Tesla and Apple. But yeah, choose a couple of companies, use kind of the criteria that we've used. Is it liquid? Is there over a million shares traded per day? Kind of look at that, make sure it's liquid. Maybe even look at the options market, 45 days out, see if there's a tight bid-ask spread. We talked about things that, if it's pennies wide, that's good. You don't want something where the spread is, dollars wide normally on the bid and the ask. But and what we'll do is we'll take your companies and we'll take your assumptions and we'll try to build some option strategies around those. And then we'll let you put those trades on in your accounts. And I would love it if you could share your screen with me and I will walk you through how to place the trades, which I think would be very educational for you. Good. So what we want to do,
45-day term.
well, we'll
bullish
probably do
prediction.
less than that. And the reason is, Katie, if something is tested, I'd like to see you guys take assignment of some shares into your paper accounts. I think would be really fun. So we may do something 7 days or less just to see what happens when you are put stock. So I want some of you guys to be tested. I want you to be put stock. And then I want you to come back and go, okay, now that I got the stock, what do we do with it? So we're going to play some, you guys are going to be traders next week, which is going to be really, really cool. So again, pick 2 companies, tell me bullish, bearish, or neutral, and try to have your platform going so that you can share your screen and I can walk you through how to make some bullish, bearish, and neutral trades on these. I think it's going to be very, very, very fun for you guys next week. Then the following week, we will have no live classes at all because I am going to be in Bahamas, baby. Praise the Lord Jesus. Hallelujah. So y'all have a week off. We'll still have your readings and everything, but there'll be no live classes the following week. All right, any questions or comments before I let y'all go? Yes, Isabel.
My question is about the TSP. It was in the book. It's in I believe it was chapter 18. No, chapter 19. He says if you had, my husband is military, so we have TSP. And he said if you had TSP, he wouldn't change it. He says it's because it's got the smallest expense rate. Yeah. So my question was, do you still have yours?
No.
You took it all out?
I do.
I add something to that.
Yes, Evan.
So I had a TSP for a while, and the issue that you run into is when you leave the military or one of these other organizations, or you have one, you're not able to contribute money anymore. So you can leave what you have in there, and you're going to have a low expense ratio. But what ends up happening is you might have your TSP, and then an individual brokerage account, and then a 401k with your work. And before you know it, you have money in all these places. And I think a lot of people go, all right, I just want this in one spot where I can keep track of it all and it's easy to see. So I think that that's one thing that you have to keep in mind too, is you're not going to be able to contribute to it once he leaves. So,
but now that's exactly what I use for accumulating wealth and retirement is C Fund. I did the max contribution I could, and I did it from 18 on to I could contribute no more. So that's what I would, I was in the C Fund. C is the S&P 500. So at some point, we're going to talk about chapters 16 through 20, and they now have these target retirement funds in there as well. I never played with those at all. I was just in the C Fund. Out of curiosity, how can you kind of give us some indication of how you got it split up or what y'all are doing with the TSP? And that's Thrift Savings Plans for those of you that don't know what the TSP stands for, Thrift Savings Plan.
Well, I wasn't real involved with it because this is all way over my head. We thought it was just like a 401k plan. We didn't know anything about it. And my husband's, I guess they have like financial advisors that kind of tell you what to do with it, since some people just don't know what to do with it. And at like certain ages or certain stages of their military career, they tell you what percentage to put it in. And he just kind of followed those guidelines. And now we're at maybe like 15 days from retirement. So we're just kind of, what do we do with this? You know, the book says, keep it there. And I'm like, wow, what do we do? So I'm freaking out.
Okay. Yeah. Well, look, and the thing is, you don't have to decide today. You can leave it there for a year, 2 years, or whatever before you want to move it out. So, you know, I think you're fine there.
If
So
you
don't-
say you're freaking out, don't make a decision yet.
Right. Don't make a decision.
Okay.
Are we doing a live meetup? I know you had a survey on that. Have you come up with a date on that?
Yeah, I would love to do a live meetup. Have any of you taken the survey? I've not seen the results of that. If anybody can be in Tuscaloosa, so I don't know where everybody's at and everything, then I like coming down once a semester. Would love to do that. So, you know, how many could make it if we had a meetup in Tuscaloosa? Isabel can't. She's in Alaska, for God's sakes.
I
She's
mean,
not-
I could take a plane.
Yeah, but why would you take a plane just for, you know, just to chill out for a day? I
I've
don't know.
never
unless you-
been to Alabama before.
Well, girl, you have missed a lot. What are you talking about?
You come when you walk.
Look at Jawan's face.
Well, like, hell, I ain't coming. Oh, it'd be fun. I mean, y'all say I'll look at yeah, 15 days to retirement. How exciting is that? That is exciting. Are y'all
You know, meet
excited
up at
about
Waffle
that?
House in Tuscaloosa.
Oh, I love the Waffle House. That's what
Whoa.
we'll all go to Waffle House. That'd be great.
I vote Chick-fil-A. We don't have
Chick-fil-A?
one up here.
Y'all don't have Chick-fil-A up there?
No.
No, I love Chick-fil-A. It's good. I had McDonald's today. My wife says, "Is that what you eat all day?" If they didn't offer such great coupons, y'all. So if you got their mobile app, it's 20% off. I mean, how can I say no to that? Every day they give me another 20% off coupon.
Because your trainer said to say no.
Maybe so. I had 10 chicken nuggets and sweet and sour sauce, which is delightful. Well, I love it. All right, guys. Great session today. I'll see y'all Tuesday. Get you 2 companies and let's do a little trading next time. Bye-bye.
Bye, y'all.
Roll Tide.
See you guys. Thank you.